If we wanted to back our debt with 51% gold, which would stabilize, by the way, because at 40%, you basically stabilize the monetary system. So you would have to get the gold price up to $75,000 an ounce to stabilize the current system, given the current debt, assuming we never add any more debt and we solve our fiscal issues, which we're not doing, because you can see the trend is that our budget deficits get higher and higher, and that our trade deficit gets higher and higher. So we can't manufacture or build our way out of this debt. We simply have to cut spending, which we're not doing. We're increasing spending, and we're not increasing tax receipts and other fees and things that we can use to offset what the government spends. So I don't even know if $75,000 an ounce would work unless we stop spending too much money and printing currency right now.
The surging United States national debt has reached an astronomical level that threatens global monetary stability. Escalating trade deficits and uncontained government expenditures are rapidly compounding a structural fiscal crisis that manufacturing growth alone cannot fix. RobKientz, a prominent financial analyst and former auditor, argues that the global financial system is facing unprecedented systemic risks due to these irresponsible currency printing practices. He highlights a stunning prediction that the gold price would realistically need to skyrocket up to $75,000 an ounce just to stabilize the current debt-burdened monetary system, given our current trajectory. With the expected budget deficit continuing to expand, mere cosmetic adjustments will fail to safeguard the eroding purchasing power of the fiat currency. Central banks globally recognize this vulnerability and are aggressively accumulating bullion reserves at rates not seen since the traditional gold standard era. This profoundly unfolding catastrophe demands immediate attention from every single investor looking to preserve capital in these highly turbulent financial times. Now, we present the clips from RobKientz's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
The U.S. currently, as of today, has $39.415 trillion in national debt. The 2025 budget deficit. Okay, so the national debt is what we owe on treasuries, largely foreign held, some in the U.S. The 2025 budget deficit is, by itself, the budget deficit of $1.78 trillion, meaning we took less in of tax receipts and tariffs and things than we spent in 2025 alone of almost $2 trillion. 2026 expected budget deficit is expected to grow to $1.9 trillion. So we're just keep adding on more debt because we're spending more than we're making in receipts. And if you look at trade for 2025, we lost in trade almost $1 trillion, $901.5 billion. So let's take all the U.S. gold holdings at today's spot price down here in this table. At the current spot price, all the U.S. gold holdings is worth $1.072 trillion. So if we took all the gold at current prices and pledged it to back bonds or pledged it to back something, it would make up for the 2025 trade deficit, imports versus exports. It would not handle either the 2025 or 2026 budget deficit with the government spending versus what they're receiving. And it is it's 1/40th of the current debt. So if we took all the gold and backed a bond or backed the U.S. system in some way and valued it today's dollars, would it solve any of these issues? And the answer is no, it would not. It would be a drop in the bucket of the current financial issues that the U.S. has. Well, let's say that gold is valued at $10,000. Let's say we just give it a $10,000 number. That would, all U.S. gold holdings would equal $2.615 trillion. It would solve the 2025 budget deficit. It would solve the 2026 budget deficit. It wouldn't solve them together. And it sure as heck wouldn't handle the national debt. So does that, it gold at 10,000 multiplied by the U.S.'s gold holdings, would that solve the problem? No, it would not. Now, what if gold were 20,000? Well, we would have 5.23 trillion in valuation. That would handle 3 or 4 years of U.S. budget deficits, but it would not handle the debt. So what would have to happen is we'd have to value gold at 20,000. Issue these bonds or other, support it in some other way, however you want to do it mathematically. Then we would have to balance the budget and then somehow use this to pay down debt. And then we would still have a whole bunch of debt we can't pay, and which could crash the value of our dollar after spending all the gold at a price 5 times the current spot. It still wouldn't solve the problem. Ouch. So maybe in 1981, this idea would have worked. Right now, there's no chance in hell it will work. Now, here's a nice little chart from Tavi Costa of Zurich Capital, and he put U.S. gold reserves as a percent of government debt. You can see that this number has steadily decreased since the high in about 1939. That as a percentage of government debt, we're one of the lowest valuations. And that's with gold going up a lot the last 2 years. In other words, we can't back our debt with gold. The debt has increased way more than the gold. We printed more currency than the gold is worth in today's spot price. And the golden price applied by a 51% debt backing. If we wanted to back our debt with 51% gold, which would stabilize, by the way, because at 40%, you basically stabilize the monetary system. So you would have to get the gold price up to $75,000 an ounce to stabilize the current system, given the current debt, assuming we never add any more debt and we solve our fiscal issues, which we're not doing, because you can see the trend is that our budget deficits get higher and higher, and that our trade deficit gets higher and higher. So we can't manufacture or build our way out of this debt. We simply have to cut spending, which we're not doing. We're increasing spending, and we're not increasing tax receipts and other fees and things that we can use to offset what the government spends. So I don't even know if $75,000 an ounce would work unless we stop spending too much money and printing currency right now. And who is going to allow us to back a bond or a currency with $75,000 gold when the current spot price is $4,100? That's a fairy tale. That's not going to work.
Sovereign bonds backed by tangible assets are frequently proposed as a viable mechanism to restore global confidence and enforce structural fiscal discipline. However, analyzing the actual mathematical realities quickly reveals that relying on current domestic gold holdings is completely mathematically insufficient to offset decades of unrestrained fiat currency expansion. A major macroeconomic shock is looming on the horizon as a critical foreign nation faces its own severe domestic crisis. It is predicted that Japan will inevitably be forced to liquidate and sell its massive holdings of American treasuries over the next 5 to 10 years in order to stabilize its own domestic economy. This unprecedented massive liquidation will dump immense supply onto the open market, sparking catastrophic disruptions and major problems across the entire domestic treasury market ecosystem. Pledging bullion at artificially elevated valuations cannot solve these systemic deficits or prevent the imminent devaluation of paper currency reserves globally. Now, let's get back to the interview.
The Fed's already failed, the U.S. government's already failed, the Treasury and the government's already failed at keeping the Constitution's guarantee of stable money. And if we issue these gold-backed bonds, we'll get back to a stable money standard. Again, all this does is tell the world that our dollars and treasuries are basically trash and not worth what we say they are, and the government's lying on its statistics. And it also tells U.S. citizens that. That's the message you're delivering. She puts it right here in a little bit softer language, so as not to say it the way I'm going to say it, but you know me, I'm a former auditor, I'm just going to tell you the truth. That's what she's saying. Now, would that work? We'll get into whether her proposal here would actually work when we look at the numbers. And you got to look at the numbers. It's a great argument. And this might have worked when the U.S. had less debt and fiscal problems. But when you see the size of those fiscal problems to the current value of U.S. gold held, boy, it changes that analysis real quick. So the math says this will not work. And I'll get to the math here in a moment. But we got more. One more excerpt from her book. For the first time in 4 decades, the U.S. government would be holding itself accountable for fiscal and monetary policies that debase the value of the dollar. On the global stage, the issuance of TDBs would be viewed as an act of bold economic leadership, providing a clear indication of American resolve to stabilize the dollar in terms of the universal monetary surrogate gold. She's basically acknowledging that gold is true money. If you look at Basel III, gold is seen as basically riskless money. Some people call it a high-quality asset. It's really like a Tier 1 asset. And basically, the central banks have been buying more gold than almost any time in history in 2025. And right now, they hold 36,000 tons, which is near the 38,000 ton holding that the world central banks held during the gold standard. So the central banks already have about as much gold as they had than at the peak of the gold standard. So they already know the gold has more value. And that was solidified in Basel III and also solidified since 2011. Central banks have been buying gold hand over fist at record levels almost every year. Purchases not seen such the gold standard. What are central banks of the world doing? They're backing their financial systems and their currencies with gold. The U.S. has not increased its gold purchases since 1971, and we don't even know if they truly have it because we don't have a public audit. A public, we can verify, true independent audit. We don't have one. So we're assuming we have the 8,100 and whatever tons, but we don't know that we do, and we haven't increased that since 1971. That's 55 years. The rest of the world is doing that because the rest of the world sees what the U.S. hasn't done, which is increase its gold holdings. But the world sees what the U.S. has done, which has multiplied its debt to astronomical levels, highest in the history of the world, and also printed more dollars than any other country had printed fiat dollars in the history of the world. The introduction of gold convertible sovereign bonds, or TTBs, basically gold-backed bonds, would establish an American beachhead for establishing coherent international monetary arrangements more suitable to our widely professed commitment to global free trade. An American beachhead for establishing coherent international monetary arrangements, professed commitment to global free trade. She's basically saying these would help with the global trade and solidify U.S. global trade. I'll get into the current account balance, which is the trade balance, imports versus exports, here in a moment, where I'll come back to that paragraph, or that part of the paragraph. Moving on, gold has served as a widely accepted form of money throughout history, getting renewed popularity in recent years. Credibility currencies has been called into question. Well, yeah. It is cited by the World Bank chief Robert Zoellick in 2010 as potentially offering a reference point for cross-border monetary relations might help alleviate the threat of currency wars. In other words, we need to introduce currency back in the system everywhere to prevent currency wars. Well, I'm sorry, we already have currency wars. We have geopolitical wars, we have currency wars, we have trade wars, we have cybersecurity wars, we have every war you want. Would it do that? Would gold stabilize trade? Some sort of gold backing? Well, it could in a perfect system in which the U.S. hadn't already destroyed its financial system. But let's get to the numbers here in a moment. One or two more excerpts. What about China? She talks about China in her book, and then she talks about other like BRICS or other nations outside the U.S. as well. We're going to go over that next couple of slides. So she says, China would likely be the first major nation to follow the U.S. lead by issuing its own series of gold-backed bonds. It should be encouraged to do so by U.S. officials. Oh, wait until you get to the analysis of potential China gold holdings and tell me who has the advantage of gold to currency printed, China or the U.S. Oh, this is where it gets really good. But I'm just going to read the excerpt now, and then we'll get to the numbers. The yuan largely tracks the dollar. So the proposition is presumably no more risky for China than for America. This is not correct. The yuan does not track the dollar. The yuan and the dollar have different relative valuations. Period. So this isn't entirely true. The China did not peg their yuan to the dollar. Okay. That's basically what we'd have to do to largely track it. Largely means it doesn't really, but both have been expanding their money supply. That's really the only similarity between the value of the yuan and the dollar, to be honest with you, on like a data basis. In other words, there's not a strong correlation as she says there is, if you look at the data. Indeed, given that China is the largest foreign holder of debt securities issued by the U.S. government, the nation might welcome the opportunity to reinforce a new American commitment to fiscal discipline. Actually, China is no longer the current holder of U.S. treasuries. Japan is. And Japan's going through a major crisis, economic crisis. Their bond rates are soaring. They're in serious trouble. And more than likely, they're going to sell their U.S. treasuries over the next 5 to 10 years in order to stabilize their own economy. They're going to have to sell assets. They ain't selling the gold. They're going to sell U.S. treasuries, which is going to dump them on the market and cause major problems with the U.S. treasury market because Japan is now the largest holder. Moreover, current pressure from U.S. Congress is directed at China's presumed manipulation of its currency, blah, blah, blah. And they're saying, well, basically, China could jump on the bandwagon. So in other words, each country is going to do this individually, and then we're going to reinforce trade in our valuation of our currencies. But none of these other countries are going to call the U.S. on its gold holdings. None of these other countries are going to call the U.S. on how much currency it's printed. None of these other countries are going to take advantage of somehow getting the gold, either buying the bond directly or getting the gold when the bond is redeemed by U.S. citizens. None of these other countries are going to jump into the gold markets to manipulate this trade to affect the U.S. negatively. We're all just in this kumbaya boat sailing down the river, and we're all going to help each other out. Is that the way the world really works when you look at it? I don't think so. Look at the Iran war right now. And who's helping Iran? China and Russia. And who's on the U.S. side? U.S. and Israel, maybe some other partners.
Geopolitical friction and hidden financial warfare are rapidly replacing international cooperation, rendering idealistic trade frameworks obsolete. Nations are actively weaponizing economic mechanisms rather than collaborating to build mutual stability. Amidst this friction, severe fiscal realities demonstrate that the current path of unbridled money printing is entirely unsustainable. Experts predict that the upcoming 2026 domestic budget deficit is expected to swell to an unprecedented $1.9 trillion. This compounding liability ensures that currency debasement will accelerate, especially since foreign allies face their own breaking points. Specifically, a massive treasury sell-off is predicted over the next decade as overseas holders dump assets to stabilize local markets. Furthermore, mathematical models indicate that resolving this fundamental imbalance would require gold prices to rise to $75,000 per ounce to stabilize the current monetary architecture. The global economic paradigm is shifting rapidly toward tangible assets, leaving unbacked fiat structures exposed to sudden collapse. Preparedness remains the only defense against this unfolding crisis. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.